This is Ralph Sass. This is the lecture for Accounting 212, Chapter 8, second part. Beginning with cash disbursements. Remember, we're talking about budgeting, and we are creating a number of different budgets, and we just created one for our material purchases. And now we have to figure out how much cash is going out to for those purchases. So if you'll recall, they purchased each unit of output needed 5 pounds. Each one of those pounds cost me 40 cents. And notice also that just like with our accounts receivable for our sales, 1/2 of the month's purchases are paid for in the month of purchase. The other half is paid in the following month. Okay? So even if we buy it all this month, we're not going to necessarily pay for it all this month. We're only going to pay for half of it. And notice we have accounts payable balance is $12,000 at March 31st. So, how much cash is going out? Our cash disbursements, we have $12,000 from March going out in April. Then we have to take our purchases, okay, 140,000 pounds at 40 cents a pound. And where did the 140,000 come from? It came from our material purchases budget. And then we're going to pay half in April, half in May. And then our May purchases, and we're going to pay half in May and June. And then our June purchases, and a couple of quick notes. And probably should have mentioned this on some of the other ones too. This 28,400, okay. Keep in mind, there's going to be half of it that's going to be in, that other half is going to be in July. So at the end of the quarter, what's our accounts payable going to be? 28,004. So it was 12,000 on March 31st, and on June 30th, it's going to be 28,400. So that's our cash disbursements. I should point out, just for materials. Next, we need a direct labor budget. And keep in mind, for direct materials, there may have been 100 materials that went into that product, so there might have been 100 material budgets. And keep in mind, they all may have had different terms. So some of them may have been paid 50% in the month, some of them may have been paid 100%. Some of them may not have been paid until the 100% until the next month. So, I mean, we're just doing one, but there would be potentially hundreds of material budgets. Here we have a direct labor budget, okay. Each unit of product requires 0.05 hours, which is 3 minutes of labor. They have a no layoff policy. This is where, some of those things we've talked about earlier in the semester are going to come into play. And for the next 3 months, labor force will be paid a minimum of 1,500 hours a month. We can have a lot of different assumptions with these. These are just the assumptions we're using for this example. So we have 26,000 units of production in April. Each one takes 0.05 of an hour. So there's 1,300 hours, 2,300 hours, and 14.5. We've guaranteed a minimum of 1,500 hours. So in this particular case, in April, even though they only worked 1,300, we've guaranteed them 1,500. And in May, where we guaranteed them 1,500, they actually worked 2,300, so they're going to get paid presumably overtime. And those 2,300 hours, at this case, are $10 an hour. There may not have been any overtime. I think I've got that in one of the later slides. So that then becomes our direct labor budget. Oh, I should just go back. In the event there was overtime, there's a number of different ways to do it. If you take a look in your text, but we could have paid, another 800 hours. Why 800 hours? The difference between 2,300 and 15. If it was being paid at time and a half, we could have just multiplied it times 5 to get the additional overtime in that particular case. So there, you can modify these direct labor budgets to account for whatever you may have going on in your particular organization. Now we have a manufacturing overhead budget. Notice we have to make some interesting assumptions here. In this particular case, the variable overhead rate is $20, okay, per direct labor hour. They have fixed manufacturing overhead of $50,000. It includes 20 grand in non-cash costs, which is usually depreciation. The reason why we have to keep track of that is because even though it's an expense and it'll impact our income statement, it will not impact our cash flow. So now we can go ahead and prepare our manufacturing overhead budget. There's our direct labor hours from our direct labor budget. The overhead rate is $20 an hour. So that gives us that $26,000 for April. Now we have to add our fixed manufacturing overhead costs. Okay, we have to add our fixed, which gives us our total manufacturing overhead costs. Those are important because those are going to show up in our income statement. Then we have to subtract our non-cash charge, in this case 20 grand, and that becomes then our cash disbursements. The reason why this is important is that 251 there is going to show up on our income statement as expenses, okay, and our cash disbursements down here are going to show up on our cash disbursements and cash receipts budget, which we'll prepare in a couple of minutes. Ending finished goods budget. How much materials, what have you, are we going to have in finished goods? Keep in mind we had 5 pounds at 40 cents a pound. We had direct labor, and we had our manufacturing overhead. That $49.70 was calculated on the earlier slide, where they took the total manufacturing overhead for the quarter divided by the number of hours. That's the applied rate. So the total cost is $4.99. So they take the $4.99 times the ending finished goods inventory. Where's that going to come from? That's going to come from the production budget, the finished goods inventory and the production budget. So there's the 5 grand. So what's our ending finished goods inventory? $24,950. Where is that amount going to show up? It's going to show up on our balance sheet. Next, we have to budget for selling and administrative. Okay, they've got a variable and a fixed portion, and once again there's a non-cash charge of 10 grand for depreciation, which we need to account for because that is a non-cash charge, so that's cash that's not going out the door. So our budgeted sales are 20 grand, our variable selling and admin rate is 50 cents, so our variable expenses are 10 grand, our fixed are 70 for a total of 80 grand. Non-cash expenses are less 10, so cash, selling, and admin expenses are 70 grand. So in April, we're going to have $70,000 that's going to go out for selling and admin expenses. We can do that for all of the months there. And our total cash expenses for the quarter for selling and admin expense are 230 grand. Now we need to put together a cash budget, and the cash budget is done virtually last. Okay, we still haven't done an budgeted income statement and a budgeted balance sheet, but it's done last because we need to collect information from all of those other budgets, okay, before we can do the cash budget. Cash budget has basically 4 parts. It's got a cash receipts for all the cash coming in. Usually that's going to be from sales and accounts receivable. Cash disbursements, the cash going out. Keep in mind that's going to include direct materials, direct labor, manufacturing overhead, selling, general and administrative. All of those budgets that were done before are going to fall into the cash disbursements. Then what we're going to do is we're going to have a cash excess or deficiency, and it'll tell us if we need to borrow any money to cover our cash flow, because keep in mind our employees want to be paid. Okay, and then we'll have some sort of a financing section where we're either going to repay the loan or take the loan out and pay interest or what have you. So those are the major parts of a cash budget. Now we're going to assume a couple of things. First off, we're going to assume that they maintain a 16%. That interest rate's a little high these days, but that's okay. Open line of credit for 75 grand. What that basically means is their banker has given them a checking account with the $75,000 balance, and if they need any extra cash, they can basically just write a check for up to 75 grand. The bank requires them to have a minimum cash balance of 30 grand. Okay, so they always have to have $30,000 on hand. Okay, They borrow on the first day of the month and repay at the end of the month. That just makes our interest calculations easy. They're paying a cash dividend of 49 grand in April. They bought some equipment. They paid for it in cash. And their cash balance at the beginning of April is 40 grand. So they started with 40 grand. Then we have the cash collections of 170 grand. That's coming from our expected cash collections from when we basically were putting together our sales budget. Then we have our disbursements from the direct materials, direct labor, manufacturing overhead, selling and admin. Those are all the monies going out, not necessarily the expenses and the dividends. So we have 230 going out. So we're short by 20 grand. Cash available is 210. Disbursements are 230. So we're short by 20 grand. We need to always have 30 grand in the bank. So in this particular case, we needed to borrow 50 grand. Now, that 30 grand ending becomes our beginning balance in May, and then we go through, take our cash collections, cash available, what have you. We have 430,000 in cash coming in, 400,000 in cash going out. Our balance is 30 grand, so we're not going to borrow anything. We're not going to pay anything off. We're just going to leave it go to 30 grand. That's going to come up here in June. And there's June. Oops, sorry about that. There's June. 30 grand, 335. Notice total cash available 335, cash going out's 270. Okay, so we have $95,000 in cash. We can now pay off the loan. We're going to pay it off for 50 grand. We also have interest, 50 grand at 16%. We borrowed the money for 3 months. We borrowed it in April, paid it off in June. So we have all of April, all of May, all of June. The reason why we made that assumption that you borrow the money at the beginning and you pay it off at the end was so that we would make this calculation as easy as possible. So they owe $2,000 for interest, and their cash ending is 43 grand. And once again, we have to be careful here with our additions and subtractions. That 43 grand there shows up there. The 40 grand is from the beginning balance in April. Bottom line is we have to be a little careful where we get those numbers, and we just can't add the columns across, because that will lead us to some incorrect and strange numbers. Now we can put together a budgeted income statement, and the thing to realize is everything on this is coming from all of those other budgets. Okay, so we get the sales from our sales budget and ending finished goods inventory. We get our cost of goods sold from our ending finished goods inventory. We get our selling and admin expense from that budget, interest expense from our cash budget. So our net income is 239 grand, and then we can go ahead and put together our balance sheet. We need a couple of other of those permanent accounts that we haven't done anything with, and we need to take a look at those. So, where are some of these numbers coming from? The 43 grand is coming from the cash budget. Okay, our accounts receivable here is coming from our sales budget. Our raw materials inventory is coming from our materials budget. Our finished goods inventory is coming from our finished goods, our budget, our manufacturing budget. Land and equipment are permanent accounts, 564. Accounts payable is coming from our purchases. Common stock doesn't change. 336 goes up because of our net income from our prior slide, adding that to our net income of what it was before. Okay, so let me just go back just to show you quick. Retained earnings was 146. My net income was 239. So 146 plus 239 minus the dividends will give us that 336. That's how we're going to go ahead and get that 336. That concludes the lecture for Chapter 8. As always, if you have any questions, let me know. Thank you.